Welcome to The Explainer. Today, we're opening up the bank survival guide. And listen, we're zooming right in on the single most critical step of evaluating a bank's true health, which is asset quality. We're going to completely forget the noise of headline profits for a minute. Instead, we're stripping everything down to the exact granular metrics that actually tell you if a bank's foundation is solid or if the whole thing is secretly crumbling. Okay, let's dive into this because this quote, which comes directly from our source material, sets literally the highest stakes possible. This is where banks actually fail, so spend real time here. I mean, really think about that for a second. Banks don't typically collapse because their marketing budget was just a little too high, right? Or because they rolled out their branch network a bit too slowly. No, they fail because the money they lent out doesn't come back. It's that simple. The source material explicitly labels this section, and I mean this quite literally, the part that sinks banks. So if you're analyzing a financial institution and you kind of just rush through this step, you are completely missing the existential threat. This is the absolute core of risk management, and it requires our complete, undivided attention. And this brilliantly illustrates exactly what we need to focus on. Step 3, read the asset quality. This is the exact moment in the analytical checklist where professionals stop looking at the shiny profit engine and start looking for the hidden rot. The source text gives us 3 master keys to unlock this truth: GNPA, NNPA, and PCR. Now, if you can master what these 3 little acronyms mean, and more importantly, how they actually interact with each other, you are going to have a superpower when it comes to reading financial statements. You won't just see the profit they made today. You'll see the massive losses they might be hiding for tomorrow. To make these financial terms a bit more visceral and easier to remember, I want to introduce a physical metaphor that the source material strongly points toward. Imagine a fall. Anytime a bank lends money, there's a risk of a fall, a risk that the loan just goes bad. In our framework here, the bad loans are the actual drop. That's gravity pulling you down. But, a well-run bank doesn't just hit the concrete. It actually anticipates the fall and puts down padding. That padding is the money they proactively set aside specifically to absorb the blow. And then finally, there's the net impact. How much does it actually hurt when you hit that padding? The drop, the padding, and the pain. Keep that image in your head as we break down the specific banking metrics.
Let's start with the drop itself, GNPA, or gross non-performing assets. By definition, this is simply the percentage of the bank's total loan book that has gone bad. This is the absolute starting point of bank stress. When we talk about the hard fall, this is it. It represents all the loans that are failing right now before any safety nets, provisions, or write-offs are factored into the equation whatsoever. It's the unfiltered, raw measure of the mistakes a bank has made in its lending engine. So if a bank lent out $100 and $3 of those loans have just stopped paying interest and principal, your GNPA is 3%. It tells you exactly how much of their past lending was basically flawed.
Now, what's really interesting about this slide is it gives us some immediate actionable rules of thumb for that GNPA figure. According to the source, you constantly need to ask yourself where this percentage sits. If the gross NPA is below 1.5%, well, that's considered clean. The bank is doing a phenomenal job managing its credit risk. However, if that figure creeps above 3%, that is a definitive, flashing red area of concern. Now, it's absolutely crucial to remember step 0 of the checklist here. Different types of banks naturally have slightly different normalities. A microfinance lender might swing more violently than, say, a massive corporate bank. But generally speaking, crossing that 3% threshold means the drop is getting dangerously high, and you need to pay very, very close attention to what happens next. Which brings us directly to the padding, the PCR, or provision coverage ratio. Once a bank realizes a loan is going bad, so once it hits that gross NPA bucket, the regulators, and frankly just simple common sense, dictate that the bank must take some of its profit and set it aside to cover the anticipated loss. This is the bank's proactive defense mechanism. The PCR measures exactly what percentage of those bad loans are already covered by this set-aside money. It's the literal cushion that absorbs the losses so the bank doesn't just collapse under the weight of its own bad decisions. A bank might have a high drop, sure, but if they have an incredibly thick layer of padding, the survival of the institution isn't immediately threatened. So the crucial point is this specific number, 80%. The source material draws a very clear line in the sand for us right here. A high coverage ratio, specifically anything above 80%, means that the bank has effectively neutralized the threat of its past mistakes. If they've already set aside 80 cents for every single dollar of bad loans, it means there's very low future earnings risk from those existing bad loans. The bank has actually already taken the pain on its income statement in previous quarters. They aren't going to have to suddenly drain their current profits to cover those old mistakes. An 80% PCR is a massive glowing green flag for the safety and resilience of the balance sheet. And finally, we reach the net impact, the actual pain the bank feels when it hits the mat. This is the NNPA, or net non-performing assets. Mathematically, it's just what remains of the bad loans after you subtract all those provisions we just talked about. If GNPA is the total bad loans and PCR is the money set aside to cover them, well, NNPA is the unshielded risk. It's the raw damage left over after the bank hits its padding. If this number is high, it means the padding was way too thin, and the bank is going to have to scramble, most likely by sacrificing its future profits to cover the gap. It's the true measure of vulnerability remaining on the books right now. Let's move to and see how this builds into a complete picture. Because the true magic of Step 3 isn't just looking at any of these numbers in isolation, it's looking at the gap between them. The gap between gross NPA and net NPA tells you exactly how well cushioned the bank really is. If you see a bank with a gross NPA of 4%, which we know is totally in the concern zone, but their net NPA is only 0.5%, you immediately know two things. One, yeah, they made some bad lending choices in the past. But two, they've been incredibly aggressive about building a massive cushion of provisions to cover those exact mistakes. The gap itself is literally the visual representation of management's conservatism and the balance sheet's true underlying strength. I want you to ask yourself this question every single time you look at a bank's earnings report. Is the net NPA near zero? Seriously, think about what that implies. If the net non-performing assets are hovering right around zero, it means the bad loans are already fully provided for. The bank has essentially paid for its past sins entirely. There's no lingering poison pill waiting to just destroy next quarter's earnings. A near-zero NNPA means the management team has completely walled off the risk, and all the new profit the bank generates from its spread engine can actually flow straight down to the bottom line, rather than being desperately diverted to plug old holes in a sinking ship. But recognizing a near-zero NPA today isn't quite enough. The source material is very clear that a static snapshot will only get you so far. You have to ask, is the trend improving or deteriorating quarter on quarter? Because asset quality is a moving target. If gross NPA was 1% last year, 1.2% last quarter, and 1.5% today, well, you've got a deteriorating trend. Even though 1.5 is technically still clean, the momentum is completely against you. Fresh stress might be quietly building beneath those headline numbers. You absolutely must look at the historical trajectory of these metrics over consecutive quarters to see if the bank is fundamentally getting healthier or if the storm clouds are just starting to gather. All right, to make sure you have everything you need, here's the exact practical checklist of the metrics you literally must pull from the financial statements to complete this crucial step of the survival guide. First, the gross NPA percent. That's your raw drop. Second, the net NPA percent, your unshielded risk. Third, the provision coverage ratio, the absolute strength of your padding. And finally, always keep an eye out for any contingency or floating provision buffers. This is essentially extra money the bank holds well beyond regulatory requirements. Think of it as double padding for a really, really rainy day. If you pull these 4 data points, you have everything you need to accurately judge the asset quality of any lending institution. So I leave you with this final, absolutely critical thought. How well cushioned is the bank you are analyzing before disaster strikes? Seriously, don't wait for a recession or a brutal credit cycle downturn to find out if the padding is too thin. Apply this GNPA, NNPA, and PCR framework right now. Look at the gap, check that quarter-on-quarter trend, and see if the net impact is actually near zero. Because as we learned right at the start of this explainer, this is where banks actually fail. Your job is to spot that failure long before it ever happens. Thanks for joining me on this explainer, and happy analyzing!